Everybody is entering the crypto game with the idea that it's relatively easy. We just follow the trends. When Ethereum is crashing, we rather stay out. When it's recovering, we rather buy. The issue is that noise versus trend is very hard to separate. We think that prices are going down and suddenly we see a rally. We think we are in a bull market and suddenly we have a surprise crash. But it's very hard to find out where the trend is currently headed. Now, I've talked about this strategy several times on this channel, just following the moving average in Ethereum. The problem though is that we have those fake outs every now and then. The price goes above the moving average, then below, then above. The idea, of course, is that we want to follow the trend, right? We want to rather bet on falling prices when we are going down, and we want to bet on rising prices when we are going up, when the price is above the moving average. But those fake outs, they are the problem, because they lead towards buying high to then sell low again, to then buy high again. So really, what can we do about this? There are several approaches. So let's say we've got our Ethereum price over here, right? It's fluctuating. And then we have our moving average, and it tends to follow the price, but every now and then we get our fake outs. We don't necessarily always bet on the right direction, right? We might be selling over here to buy back in over here, to sell over here again, to buy back in over here. That is very, very expensive. So there are several ways to solve this potentially. One way is to maybe build a buffer around the moving average. So we say we have to at least cross a certain buffer, and only once we are above that buffer, then are we buying. So that would be over here, for example. And then we would be selling when the price crosses the lower buffer. Now, I've backtested that idea, but unfortunately it doesn't work. When we look at different buffer sizes around the moving average, if we look at different assets, if we look at the outperformance versus simple price crosses over time, it doesn't really do much better. So that's why I just use the direct crosses from the price to the moving average. But that's not the end of the story. There is a way to improve the strategy, and that's again through backtesting. So we simulate buying and selling Ethereum based on different trading rules. And there's a better trading rule than just buying and selling when we are below or above the best moving average. But let's go step by step. Let's slow down a little bit. If we were just to use the moving average itself, we would now be buying. There are several ways to apply the strategy. So for example, we can simply just sell whenever we are below the moving average. So that's then here the portfolio line, that's the line in blue, versus buying and holding Ethereum. So every now and then the portfolio line goes flat. That's when we are in cash. If we did that with the best moving average, the 33-day for Ethereum, we'd have an annualized performance of 167% versus 85%. That's mainly because we have less of a drawdown, right? We do not lose as much money during a bear market. So that's simply just going long. So we bet on rising prices, we buy Ethereum, and when we are bearish, when we are below the moving average, going in cash. But we can adjust this. We can go long and short. So when we are below the moving average, we bet on falling prices. Then our performance line is never flat. We either bet on rising or on falling prices, and we do get better annualized return from that. Yes, the maximum drawdown is increasing as well, but the annual return is going up as well. And so far I'm just summarizing content from prior videos, but we will develop this further. Now what we see over here, that's the moving average duration on the x-axis and the annualized performance on the y-axis, and the dotted line over here, that's the reference. If we were just buying and holding Ethereum, that's what we get. But if we trade according to the 33-day simple moving average, we get much more performance. This is both going long and going short. So you bet on rising prices and on falling prices. But again, the fundamental problem with that strategy is that every now and then we get those fake outs, and they are very, very expensive. So for example, over here on the 4th of March, I'm following the strategy, by the way. On the 4th of March, I bought Ethereum just to then sell it again at a price that's roughly 7% lower, to then bet on falling prices, to see the price rise by another 3%, and now we are long again. So that's 10% of a loss without leverage. Once we include leverage, the loss is even magnified. So we don't want that. But unfortunately, buffers around the moving average don't work. But here's something that might work. What about not just using one moving average? How about using two moving averages. A moving average that's comparatively quick and another moving average that's rather slow. And we would bet on falling prices when the quick moving average is below the slow moving average, and we'd be betting on rising prices when the quick moving average is above the slow moving average. This way we get much less signals, right? If we take away the price from that chart, we just look at which moving average is currently ahead. We should now be able to capture the trends without getting all of those fake outs. Now, how well does this work? And what moving average durations work the best? What combination of moving averages? Here is the first answer. So this is where I backtested, where I simulated trading with that strategy for all the moving averages up to the 365-day moving average. We can see that the longer duration moving averages don't work that well. So let's zoom into just the top 150 moving averages. Then we get this chart. This is now much more refined. Again, we can see how the shorter term moving averages tended to be the best. So let's zoom into that as well. Let's only take the top 50. So then we get this chart. This now shows the best moving average for the fast SMA duration and the slow SMA duration, what combination historically worked the best for Ethereum. And the best data point is over here. It is the 12-day simple moving average, that's the fast one, versus the 33-day simple moving average. If we go both long and short with that moving average, without any leverage, we get 221% per annum in backtested return. And that's by executing 108 trades. With the direct crossing of the moving average, we have 265 trades. We have to trade much more often, we get all of that noise, and we end up with worse performance. So how does this look like over time? Here is the chart. So in gray, we've got the Ethereum price. In blue, we've got the strategy performance. So this is quite promising. How does this look like on a chart? Here it is. The 12-day SMA with the 33-day SMA. Now, isn't it interesting that the longer term moving average is still the 33-day? So if we take the best moving average for the price crossing, it's the 33-day. If we take the 12-day SMA plus the 33-day SMA, we also get the best SMA combination. So there's something about the 33 days that seems to be consistent. And if we use the 12-day SMA instead of the price, we just eliminate a lot of the noise. This seems to be working the best. Yes, we might have our failed signals as well, but we've got much more failed signals when we trade directly the white line with the moving average. Now let's try to optimize this even further, right? We have an active trading strategy here. We want to bet on rising prices and on falling prices. Maybe we can spice this up a little bit with some leverage. Now we have to be careful, right? If we take too much leverage, there's always the risk of getting completely liquidated. So this is not necessarily a topic where we can just wing it, right? We should figure out at what point is leverage getting too dangerous. And so here is the backtest. We backtest the best leverage for our long positions, so when we bet on rising prices, and for our short positions, when we bet on falling prices. We can see that our annualized return for long positions tend to be much higher than for short positions. We can also see that we can take more leverage, so 2.25x for our longs, compared to our shorts. That's only 1.75x. We also see that once we go beyond the 3x level in leverage, we are definitely post the optimum, so performance tends to go down. And at a 4x, we are getting liquidated. So this is falling off very steeply. So you rather have a bit too little leverage than too much. But again, the optimum seems to be 2.25x and 1.75x for the long and short position respectively. What's the annualized return? Our longs give us 350% per annum, our shorts at another 21%. If we combine this, right, this is now multiplied, this is not just added, then we come to our 451% per annum. But have a look at the maximum drawdown. The maximum drawdowns are not that different anymore. So buying and holding Ethereum versus using this trend following strategy with leverage, it's pretty much the same risk. It's not the same return, but it's the same risk. So we cannot expect that using the leverage will be less volatile. It's even slightly more volatile. That is different to the strategy without leverage, where we get 221%. Here we reduce our maximum drawdown a lot. So we sacrifice a lot of potential return, but we can also sleep better at night. So really, it's personal preference. How much allocation do we want to have towards a strategy like this? If this is just play money and we are okay for this to go down by 90%, we might use the leverage. If we deploy significant capital, then it might make sense to rather be cautious and not use leverage. Just bet on rising and falling prices with 1x. But yeah, have a look at how the performances compare. This is now with leverage. So we use perpetual futures with the optimum allocation towards risk we get this year. If we just stick with the spot market where we started with, and we just use the simple moving average crosses, that's our performance. It's a big contrast, right? We can take on much more risk. We can lever this up and get way more performance. And so that's then very encouraging. We have just seen a crossing of the quick moving average with the slow moving average. And it seems like, even from a technical analysis standpoint, even though we can't really backtest this, that Ethereum tends to trade in a certain range. And that maybe there is potential upside of more than 100%, right? This is the chart setup that many people look at. Not everybody might do those fancy backtests, but many people are looking at charts like this, and they can become a self-fulfilling prophecy. So I do feel quite comfortable turning risk on for Ethereum right now. This strategy again generates only 108 trades. It's less than half what the direct moving average crosses produces. Now, of course, we cannot say for certain that this rule that worked well in the past will continue to work in the future. But I like to rather bet on trading rules than just bet on the current news of the day. Right? It's very hard to figure out how well would we have performed in the past if we just followed the news. But it's relatively straightforward to say how we would perform if we followed a fixed set of trading rules in the past. And so I simply try to analyze what kind of trading rule tends to work well consistently over time. And again, for Ethereum, it seems to be the golden cross between the 12-day and the 33-day simple moving average. Even without leverage, it generated much more return compared to buying and holding, while also reducing our maximum drawdown. Now feel free to simply execute the strategy. You've got all the knowledge yourself. If you want to get automatic copy trading, so this is where I then execute the trades for you, you just deploy your capital. Then you can do so via the Gravity decentralized finance platform. So this is all explained in the premium membership of this channel. You just put in your money. We are using leverage in that vault, so there is risk, but the leverage is carefully chosen, and we are following the approach that historically at least predicted the trend in ETH quite well. If you got some value out of this video, feel free to give it a like. It will help the channel grow. Feel free to also subscribe. I publish videos regularly. See you next time on YouTube or see you on Premium. Cheers!